participants. So I request CA Narendra Jain to come forward and take over the dais. Over to you.
Good morning. Respected Sri Madhamurthy ji, respected Chairman, dear friend Pramod, respected seniors in professions and other professional colleagues. It's always pleasure to be here and to share thoughts on various subjects. This platform has given me great learning opportunities, both being a delegate as well as speaker. So today again, when Chairman Sir said that we have to do one session or one seminar, 1 day seminar or 2 day seminar on transfer pricing, I thought it's an apt time because we all have the compliances that are coming for transfer pricing. And as Madhavmurthy ji said, there is in a small and mid-tier firms, despite this law being almost 2 decades old, there is a sort of a hesitancy when doing transfer pricing. There is a thought that this is a sort of an alien subject only meant for larger firms. Do you people have that feeling? Or there are people who have already done this, right? So there may be people who have done this. For some, it is a sort of hesitancy that whether we should do this. Because the practice today, we are occupied with so many things that doing has, again, sir said, doing every subject becomes difficult. So the idea of today's session is, today's entire seminar is to look at practical approaches in terms of how you go about transfer pricing. The law is there from 2 decades. Last few years, there have not been much of a change. Some issues are settled. There are divergent views on various aspects by tribunals. In High Court and Supreme Court, the issues are in cold storage. They're not looking and deciding on these issues. My presentation takes through the entire overview, but I'm not going to look at this subject, but the focus will be in terms of practicality, or the entire 4 sessions are planned in a way that if today you get a transfer pricing issue, how do you deal with those issues? What would be the best approaches so that the client is aware of the risks in some cases, at least the analysis is done properly, the certifications are done properly, and compliances are done properly. Otherwise, there is a lot to talk on each section. We can talk and debate each of these sections for many hours. But the focus would not be debating the sections, but focus would be debating the approach that one can take when we have a transfer pricing issue. As we all know, in 92 post-globalization, there's a huge amount of global trade is happening. And today it is estimated that roughly 60 to 70% of global trade is between related parties. So straight away to those transactions, you will find that the transfer pricing is applicable. In India, we are 2 decades old, but other economies are much matured, where are 4 to 5 decades old. What we also find now, in the initial years of transfer pricing, there were MNCs which were coming to India and having businesses, but today you find Indian businesses going abroad. And you'll also find that transfer pricing is applicable in those cases also. It is not just inbound, it is also outbound, which is in a very great extent, which is there. And more Indian companies, because they are investing outside India, you will find that more and more applicability of TP may come for many more clients. Otherwise, it was more of an MNCs who were coming into India in the initial 5, 7, 10 years of transfer pricing. That was more of a compliances we were doing. But today we find that Indian companies, manufacturing companies setting marketing offices outside India, companies having their distribution networks outside India. So even there, the transfer pricing will come. Transfer pricing is one area which has been many times used to evade tax or to reduce the taxable profit in a location where the tax rates could be high. One of the ways everyone tries to do a tax planning is pay tax where the tax rates are lower. So if I have a jurisdiction with 30% tax and a jurisdiction with 15% tax, at a group level, everyone thinks that let's see whether we can allocate more profit to 15%. And transfer pricing is a law which tries to curb that practice, right? There was a sort of competition also happening between various jurisdictions, what we call as bottom to race to bottom, how much bottom you can go in tax rates so that you attract more and more investments. To some extent, post 2015, because of the BEPS project, that has curbed to some extent, but you can't say that it is completely gone, right? So as economies grow, as businesses grow, there will more and more inbound and outbound transactions to which the TP will be applicable. This is just an example where you would try and say the purchase price is either undervalued or overvalued between related parties to show a lesser profit at a jurisdiction where the tax rate could be higher. There could be many more ways. When we talk of BEPS, right, profit shifting, base erosion and profit shifting, it is much wider term than transfer pricing. We are looking at one aspect of that BEPS. For example, if you take the aspect of interest, today the funding through equity or a loan, if a foreign company is funding Indian subsidiary through equity, the dividend paid on that is non-deductible, right? So you don't get a deduction. But if that is funded through loan, the interest paid becomes deductible expenditure in India. Also, the tax rates could be on that interest rate could be as low as 5% or 10%, in some cases 5% also. Some of the treaties give that benefit, where the dividend could be higher rate of taxation. So people who try and say that we will fund in subsidiary through a loan. Now that cannot be targeted by transfer pricing. Transfer pricing can target saying that, okay, you are giving an interest which is 12%, whereas the market rate is 6%. And therefore we are trying to say that interest portion should be disallowed. Therefore, they had to bring in new laws like thin capitalization, section 94B, where there is a loan between related parties. And if it is exceeding 30% of EBITDA, then we will disallow that loan. So when we talk of BEPS, it is much wider than the transfer pricing. Transfer pricing is one aspect of that entire scheme. Today, no doubt, our focus will be on transfer pricing and how do we approach the transfer pricing. Basic provisions, we'll spend maybe 5 minutes and then straight away move to some approaches and some issues that will come up. Section 92 says that income arising from international tax transaction shall be computed having regard to arm's length price. So we have two critical terms here, international transaction and arm's length price. And international transaction, again defined in 92B to mean transaction between associated enterprise. So three terms which we have to first understand to decide whether in a given particular case the transfer pricing is applicable or not. That is international transaction, associated enterprise. If these two tests are satisfied, then the transfer pricing is triggered. So today, if we have a balance sheet before you and to see whether the transfer pricing is applicable or not, first you need to see whether there are related parties of this particular company or whatever it could be. And if there are related parties, which you can find from the related party schedule, and if you're the auditor, you will have much better information. Then you need to see the next step is whether there are transactions with that related party. These are the first two steps that any one of us had to look at if I have to see that whether the transfer pricing is applicable or not. The related party, as we understand in a general term, and the associated enterprise, as we understand in the transfer pricing, may be different. Not necessarily they are same, because here it is defined, and here in certain cases the dimension may be slightly wider. The aspects of the control are slightly wider here. For example, shareholding, all we understand, 26% limit. Director control, we understand, half of the directors. But a party which is giving loan can become an associated enterprise in certain cases. A party which is supplying material, raw material. So if a 90% of raw material purchase is from a particular party, that party also can be associated enterprise. The idea of wider definition of associated enterprise is that they want to cover every case where there could be influence by way of a control and influence on the pricing. So someone who is purchasing the entire sales of a particular Indian entity, he naturally has a power to influence the pricing on that particular item. So that is why they have kept this gamut of definition of associated enterprise wider. So it covers shareholding, which would be most of the cases, 90-95% of cases when we encounter, it will fall in clause A or clause B. Clause A and clause B deal with 26% of voting power. So most of the cases we will find that they fall in these particular two categories. In some cases, it may fall in the next two categories of the directors. But there could be few cases which will fall in either raw material, sales, intangibles, and maybe related party in the form of individuals. So if an individual controls the Indian entity and his relative controls a foreign entity, the both of them will become associated enterprise. So first I need to see whether these two parties with which the transactions are there are whether they are associated enterprise. We need to apply the test of 92A. There's enough literature on that. I have listed this. I said we can debate this, but I'm not going into this. If there are any specific questions on this, I will address at the end. Then next aspect is the definition of international transaction. So if now the two parties are associated in enterprise, whether there are any transaction between these two parties. If there is transaction between these two parties, the definition of international transaction is so wide that surely it will be covered. And post 2012, they expanded the definition further. So now virtually every transaction is covered within the ambit of international transaction. Even a transaction like giving a guarantee becomes an international transaction. Even issue of shares become an international transaction. Even receivable becomes an international transaction because the ambit has been widened. So to say that a particular item does not fall within the international transaction is going to be very challenging. And especially when we are complying with the law, we would always tend and be slightly conservative in approach and say, okay, let's not violate the provisions. And if we know that there is an definition which covers it, we want to be conservative in the definition of international transaction at least. And believe me, it is so wide, especially the last limb itself. If you see this, any other transaction having bearing on profits, income, losses, assets of an enterprise. Now, every transaction naturally will have impact on profits, income, losses, or assets. So to say something does not fall within this is going to be extremely difficult. We had certain examples like corporate guarantee, which we said doesn't fall because it doesn't impact current profits, current income, losses, assets. It may impact in future one, right? So it is at least not an international transaction for the current year. The tribunals accepted that view, but subsequently the law was amended in 2012 and a detailed explanation was added, which brought in these transactions also within the ambit of international transactions. Now, once we, okay, and another important aspect was this SDT. No doubt the 40A was out, and currently you would only have if there is a tax holiday undertaking, which is claiming any tax holiday, and another related party with which the transactions, either it could be a tax holiday unit or a tax holiday undertaking, or 115 BAB if there is a 15% of claim. So idea again here is if there is an assessee which is having 15% tax rate and someone who is having 25% tax rate, the assessee may try and shift profits from the 25% unit to 15% unit, which is very natural because you would say that I'll pay tax at the 15% level. So if the transaction of goods and services between these two assessees, say one at 25, one at 15, if there is any transaction, then the benchmarking will come into picture. This applies only in a restricted sense today for the SDT. In between for 4 years, the specific domestic transaction from 2012 to 2016 applied even to all 48 transactions purchased from related party. If it's crossing 5 crores initially, then 20 crores. So currently that is omitted. So you have to see SDT only in cases where there are some sort of a tax holiday exemptions which are being claimed. And today with phasing out of exemptions, this may not remain very relevant except maybe 115 BAB, which is a new provision. So one needs to see whether this could be applicable. Once we cross this threshold, that there is associated enterprise, there is international transaction. Next aspect that one has to see is, if there is a transaction, how do I do a benchmarking of that transaction? How do I compute the ALP of that? That is given in 92C. Now, throughout today's sessions, the other speakers also will go into minute details in terms of how do you benchmark the transaction. I will set a tone by giving an overview that how do you look at the transactions. Now, there could be different kind of transactions. Today, when we approach transfer pricing, there could be different kinds of transactions. In my personal way, I look at it is whether there is an inbound transaction, something coming in, or there is an outbound transaction. You are providing services, exporting goods, you are providing that, right? There could be other transactions like reimbursement, purchase of capital assets. There could be financial transactions like loans, shares issues, etc. And there could be certain complex transactions like business restructuring, intangibles and all. So these could be some broad categories of transactions that we could encounter in our regular practice. Whether we are in job as an employee of a company which is an MNC or having cross-border transactions, or whether you are practicing CS. Now, these are broad items of transactions which we should think about and look at how do you apply the transfer pricing. Now, if you look at outbound transactions, there could be again in outbound provision of service, sale of goods. It could be manufactured goods, raw material, traded goods. It could be sale of digital goods or many more things, right? Now, what would be the approach for me, or what are the things that I should look at when I look at these kind of aspects, when these kind of transactions? So let's first take services. This is more common from Bangalore's perspective because we find more service transactions. It could be software development service. Again, in services, you could find various classifications: software development, ITES, marketing services, business support services, advisory services. It could be many of these services. The principle that we discuss, we can apply across these services, right? Now, if I render a service, the first question when you transfer pricing, I would ask a client is, what is the charge for the service? What is the nature of the service and what is the charge? What services have you rendered? What is the nature of your service? And for that services, what is the charge? Every service will have a different way of computing arm's length price, or at least the markup and margin for every service would be different. So if I know the nature of service and way it has been charged to associated enterprise, then I can, that is the first question that I would ideally ask for the client, that what is the nature of service and what is the charge for that service. Because if you look at ourselves also, when someone says that I want an audit service or taxation services, I have to charge it. I have to naturally cover my cost, also earn the reasonable profit for that service. No one would provide services at cost unless there are some other consideration, then it's a different issue. So if a service is provided at cost just because it is a related party, then straight away there is a problem from an associated enterprise and TP perspective. So no one would do that in an ideally third party scenario. Now, if we know that what is the service provided, then next question that one would ask is, now the Indian company, is it a captive service provider or is it providing services to various parties? Like if you take a lot of captives in Bangalore, they 100% of services to their associated enterprise outside India. So they say, okay, I'm doing software development services, entire 20 crores of turnover is to my related party, which is outside India. Now, why this becomes important is, if there is a captive, the approach one would apply to that, and the way you would do that would be slightly different when you are having services to third parties also. So let's look at captive. So if there is an US company which has set up a subsidiary in India, say for simple plain vanilla software development services, he's rendered the software development services to the US company. Now for this services, generally they would charge a cost plus markup for rendering the services. That is the most ideal scenario you would find for most of your client. So the question that would arise is, what is the cost and what is the markup? What is the cost involved in rendering the services and what is the markup charged, right? Along with this, other aspects will come. How do you select a method? What are the comparables and how you go about all of these aspects. Now in a captive, because there are no internal comparables, naturally we have to go to external comparables. You don't get internal comparables. Suppose this subsidiary was rendering 20 crore services to associated enterprise and 10 crore services to third parties, then there was some sort of internal comparison possible. That, okay, this 10 crores, what is the per hour rate charged or fixed price charged? Some sort of an analysis could have been done. But when your entire services are to related party, that internal analysis is practically very difficult, or it is not possible rather, because your entire services are to the related party. Right? Now, if you get this kind of a case, if you get this kind of a client, then what would be the most ideal services? Right? Ideal way of applying the method. There are 5 methods. Cup method, CPM, cost plus method, resale price method, PSM and TNM. This is the 6th method, which is the residual method rule 10AB. These are the 6 methods which have been prescribed in the statute. Under the law 92 CA, it is mandatory to select one method as the most appropriate method. Out of 6 methods, you have to select one method as the most appropriate method. You can't say none of the methods are applicable to me. The obligation is cast on the assessee. That assessee shall compute the arm's length price of an international transaction. And therefore, it is the assessees for who has to select a method. The broad classification of this method is, if you see CUP method, comparable uncontrolled price method, it is a comparison of price. So what is the price charged for the goods or services in the related party transaction, in the controlled transaction, that is compared with the price charged in uncontrolled transaction, in a third party transaction. You are comparing the price. Then you are comparing, if you see RPM and CPM, you are comparing the gross margin, that gross margin earned, whether it is arm's length. And if you see PSM and TNM, then there is a net margin comparison, right? So you move from top of the P&L, see price, sale price, purchase price, move to gross profit and move to net profit. And I would feel that in the same way, these methods are equally reliable. The CUP is the most reliable, most difficult to apply. TNM is the least reliable, most easy to apply. So, and in between RPM, CPM, they have their own limitations. As we go forward in the presentations, we will see it in the subsequent sessions, how the method should be selected. That also is taken. So, but to just give a broad overview again, that these are the 5 methods before us. So now in each of these methods, they have benefits, limitations. CUP compares the price. So I was saying that if you are not a captive, you are rendering services to 2 parties. You are rendering services to related party and rendering services to third parties. Let's assume the services are same, because if the services are different, then it's a different issue altogether. But if the services are same, then what is the rate charged? Is the rate charged per hour in related party transaction, rate charged to third parties per hour transaction? Can I compare that per hour rate? Then it becomes internal comparable, because there is a comparison between the parties itself. So what we call as internal comparables is where the related party, the controlled parties itself transact with third parties for a price. Then that can be an internal comparable. It could be internal comparable for CUP, or it could be internal comparable for other methods. So you need to analyze this if it is a non-captive. In a captive, you don't get an internal comparable. So the comparison at the CUP level, in the price level, becomes very difficult. You cannot really compare the price because there is no internal comparable. And when the charge is on a cost plus basis, you don't get an per hour rate. There is no possibility of applying a price method, price-based method for that. So what you do is you try and see whether you can apply RPM. RPM cannot be applied here because RPM is applicable only in distribution transactions. That means you purchase from related parties and sell to third parties. There is an import of finished goods, no value addition done, and sold to third parties. Only in that restricted sense, the resale price method can be applied. CPM can be applied to a service transaction, can be applied to manufacture transaction, but the challenge with CPM is it compares gross profit. So what it does is, in a CPM, you take direct cost, you take indirect cost. So if you see our P&L from a TP perspective, split into three broad categories: direct cost, indirect cost, and other costs. Other costs could be selling and general administration cost, HR cost, finance cost, etc. Okay, so the comparison of T&M is considering all three costs: direct, indirect, SGA, or you to say other costs. But when you compare CPM, you stop at indirect cost. So you slightly stop above the net profit level. Stop above the net profit level. So that is the comparison for CPM. Now, with the reported balance sheets, the audited financial statements, it is not possible to compute direct and indirect cost and accordingly arrive at the gross profit. Therefore, CPM becomes very difficult to apply. I would say impossible to apply in an external benchmarking. If you're doing internal benchmarking, still possible. But if you do an external benchmarking, that means I find out annual reports of comparables and then see what is their margin. In that scenario, you can't apply the CPM. Right? Then you have fourth method is PSM. PSM is again a restricted method that applies where you have integrated transactions or transfer of intangibles. So if the transactions between two associated enterprise or the operations between two associated enterprises are so integrated that you cannot segregate it, then you apply PSM, because as the name suggests, profit split. You split the profit. That means if there are two entities, you first combine them, see the combined profit, and then split the combined profits. And you split it based on the FAR. How much each of the parties have contributed to earning that profit. So if the combined profit is 100 rupees, company A in India, how much it has contributed to earn that 100? And company B in US, how much it has contributed to earn that 100? You try to identify that contribution analysis and then split that 100 rupees. In a simple terms, this is PSM. So in the scenario which we are discussing, again, PSM also may not be applicable. So what left is T&M. So in most of the captives which are rendering software development services, the T&M would be the most appropriate method. Right? So this is one thing that we have to now decided that T&M is the most appropriate method. And we have understood what the 5 methods are for. Now, if no, see, if you have a scenario, so this is where you have an internal comparable. Okay, let me first finish the captive part. I'll answer this question as we finish the captive part. Okay, now let's assume there are no internal comparables. 100% billing is to the associated enterprise. Okay, let's finish that. Then we'll come to the question where I have third party billing. Right now, when I have entire billing to AE and I don't have internal comparables, I have selected T&M as the most appropriate method. Now, from where do you get the comparables? Under T&M, I have to compare net margin. So I have my P&L, I have my net margin. I have 10% net margin, 12, 15, whatever may be the net margin, right? Now, how do I go and say that this 10 is correct, or this 12, or this 15, or this 20 is correct? For that, you need to find external comparables. And there is where this databases, entire analysis on databases will come. We have a different case study in the subsequent session, how to go out through the database. But in a nutshell, you need to have these databases. There are 3 widely used databases: Proves database, Capitaline, and ASTP. These are 3 widely used in India, which list out 40-50,000 listed companies, unlisted public companies. So the data nowadays, even private limited data is available in these databases. So these databases, you run a search on these databases. Various mechanisms to run a search have been provided by industry classification, nature of service, nature of products, nature of raw materials, NIC codes, a number of ways you do. And now they are also quite improved compared to earlier years, and it is more easy today to do an analysis on these databases with export tools and a lot of internal inbuilt formulas itself in the databases. Okay, so once I have to go for an external comparables, now we are saying I am rendering software services, right? And we say it is a mundane testing services. Let's assume it is just a simple testing services. That means for testing services, Indian subsidiary has charged, say, 100 rupees is the cost, 15 is the markup, 150. Now, what have we to demonstrate? We have to demonstrate that this 15 is correct, right? This 15 margin earned is correct. That anyone who provides testing services would have tried and earned only 15 and not 20. If someone is earning 20, then the question is, why have you earned only 15? This is the primary thing. The question always I ask myself in transfer pricing is, if you render these services to third parties, if it are not rendering it to related, if you render it to third parties, what would have you charged? If you charge 120 to third, why do you charge 150 to related parties? So now in our case, we are saying that I am rendering testing, software development testing services at 15% markup. Then I run on this databases, try to identify other companies which are rendering similar testing services. Okay, they should have certain other characteristics also, because I am doing export, they also should do export, because if they are doing domestic rendering services, market dynamics are naturally different. They should not be rendering to their own related parties, because then their own transactions are tainted transactions, which are that self influenced by control aspect, and transfer pricing is applicable to their own transactions. So I should get fairly independent parties. I should get parties which are into export of services. I should get companies which are doing software testing services or similar activity. And I should also be able to get companies which are of similar my size. I cannot compare my 20 crores turnover with say 20,000 crores turnover of Infosys or etc. etc. Right? So I should have these 4 to 5 parameters which we call as filters. These are called as filters. That means how do you filter the initial list and arrive at the final set of comparables. So the database, once you say software testing services, may say, for example, throw 500 companies. And then out of the 500 companies, you try and filter the companies and reach at a set of proper 10, 20, 50, whatever that company is, number of companies, whose margin you can compare. The law has given this mechanism. The law has given this mechanism. They say that you arrive at a set of comparables, and if there are more than one comparable, then there's a mechanism to adopt arithmetic mean or median or interquartile range. Again, these will all be discussed in more detail as we go forward. But this is a mechanism that is there, that you arrive at a comparable set. Now let's assume you get 7 companies which are also into software testing. Now these 7 may have again different margins. One may have 10, one may have 12, one may have 15, one may have 20, and one may have 40. Can you select the most highest one or most least one? The law today gives a mechanism that if you have less than 6, you take the arithmetic mean of these companies. So if there are 5 companies, add up, divide by 5, you get the arithmetic mean. Right? If you have 6 or more than 6, then you have to adopt the median and interquartile range of 35 to 65%. So you have to put the set in the ascending order and see where the 35th percentile comes, where the 65th percentile comes. That becomes your range, and you take that range. So if that range is from 12 to 18 and yours is 15, you are arm's length, no problem. But if that range is 17 to 25 and you have charged only 15, then there is a problem, because you have charged less than even the lower quartile, right? So this is what, in a simple terms, we have to do. Getting comparables, some industry is easy, some industry difficult, but that only can happen once you are looking at the database, once you are trying to make a search on the database and try to get these companies. The department also adopts a similar databases and similar comparables, and they try and say that based on this should be the margin. So if I have the captive unit where there is no internal comparables, in that scenario, then I have to go to external comparables, do a search on database, adopt a filters, and I have to select a proper PLI, profit level indicator. Profit level indicator is what is the comparison. What are you going to compare? In a cup, you compare the price. In a TNM, you compare net profit. Net profit by what? Whether you compare cash profit, whether you compare net profit, whether you compare profit before interest. So you have to define this profit level indicator. Now, when you render services, one very simple way of deciding a PLI is the components of your formula, numerator, denominator, should be independent. That means you are rendering services to A. Your sales is tainted. What we are saying is your sales is to related party, and there is a possibility of tainted element or manipulation in this sale price, right? So that whether the sales itself can be denominator? No, because then the end margin or end ratio itself will be wrong. So when you render services, you have to take margin on cost, net profit by cost. And when the other way around, suppose you purchase goods and sell to third parties, then you take, say, gross profit on sales or net profit on sales. So this is one very simple way of selecting a PLI. You try and see what is your transactions and what is that you have to decide, and what is that you have to test. In when I render services, I test sales. I am seeing whether my sales price is arm's length or not. And when I see my sales price is arm's length or not, I should not divide by sales itself. Then the ratio naturally is tainted. It is itself incorrect, right? The way you calculate your ratio, PLI, we have taken now profit by cost, operating profit by operating cost. This is what the general terminology we use. Same way calculate for all the comparables. You now get 7 comparables, rendering software testing services. Same formula you have to apply to them and see their either average or median, depending on what the case is. And see, now if you have got 15 and that is 20, then you need to see whether you are at arm's length or not. So this is one way where you are rendering services on a captive basis. Second, he asked a question, what if I am rendering also services to third parties? Now there could be multiple options here, which we have to keep it in mind. Suppose I render software testing services to my related party. I also render software testing services to some third parties. Now these third parties are also outside India, they are not domestic parties. So the question of geography and market dynamics will not be impacted. Let's assume they are also in foreign parties. The question is, are these services substantial? Are they all very minuscule? Suppose 98% revenue comes from related party, 1 or 2% comes from third parties. Can you really make a comparison of 98 with this? So you have 20 crores turnover of related party and 5 lakh rupees with third parties. I would say no, it is not proper comparison, because naturally when you render regular services and one-off services, the situation may be completely different, right? Let's move forward. Let's assume the services are also substantial in third party scenario. At least 20% of services are there. Okay, there is no decided formula anywhere. Courts have taken their own view, but I would personally feel it should be slightly substantial to make a genuine comparison. Now let's assume you get 20 crores from related party and 10 crores from third parties. Now this is a reasonably good comparison because both the parties are important to you and you render services to these two parties. Then check in these two parties the functional comparability, what we call. That means the services functions should be same. This is the first test you have to apply for related parties and unrelated parties. It becomes more easy if you have a product. I sell a laptop, I know that it is exact comparable. Services become slightly difficult, but it is not impossible. Naturally, you will have to sit and understand with the client that what are related party services, what are third party services, give some statement of work orders, get some agreements, see the terms, try to speak to some technical guy in the organization who can give you some broad description of services in related party and description in third parties. Satisfy yourself that they are comparable. They are both same, functionally similar. We call in the TP terminology, we call they are functionally similar. Okay. If you render testing services, here you render customer support or some call center services, naturally you have to discard it. There is no meaning of any comparison. But if it is of a similar type, testing services, software maintenance, possibly you can compare it. Okay. So you have to look at this sort of a understanding of the transaction. Let's move forward. Now you have two services, 20 crores, 10 crores. The question is, I can compare. Yes, functional similarity test is satisfied. I can compare. Now what? See how the pricing is charged in related party and in third parties. If pricing is on a similar methodology, then comparison becomes more easy. Suppose I charge $18 per hour in related party and also $20 per hour in third parties. Now you have a rate per hour. Okay, so possible to compare these rates per hour and ask a question, why have you charged $18 to related party and why have you charged $20 to third parties? That means you have given $2 discount. Is there a reason for this discount? So they may have given me some free cost of assets, or they have given me some software technology, etc., etc. There could be n reasons why I would have charged $2 less. For example, the software tools required for related party came free of cost. For third parties, I myself purchased it. Naturally, I want to recoup that cost. I'll charge $2 more to recoup that cost. So this you start analyzing it if there is a per rate price per hour available. Let's move a step further. There could be a situation where this rate is not available because for related party you either charge fixed price, you say lump sum $1 lakh, $2 lakh, $5 lakh, or you charge on cost plus basis, and third party you have charged per hour rate. Now then you can't make a price comparison. Therefore, I can't adopt a cup here. I have to move to other method. You can still do an internal comparison, but you can't adopt a cup. So then I look at CPM possibility or TNNM possibility based on kind of data that could be available. So if I have to apply either CPM or TNNM based on internal comparison, you have to ask the client, can you draw a segmental profit and loss account between related party and between third parties? That means now you have done 20 crores business for related party. What is the cost involved for this 20 crores? Employee cost, other direct cost, travel cost. Common cost naturally will allocate on some proper allocation key. For example, rent of a premises. You will allocate based on number of employees or employee cost. Some formula we will adopt. We are all good at that. That's not the issue. So find out what are the direct costs for related party transaction, A transactions, and what are the indirect costs for the third parties. Okay, so this can give you either a gross profit or net profit. Both should be possible depending on kind of data available. As I said, if you want to apply CPM, you have to stop at direct and indirect, and TNNM at the entity, at the net level, and allocation of common cost. You will allocate HR cost, other costs like administration cost, staff welfare, things like that. These two segments in a particular appropriate allocation key, which can be taken based on a particular quality of data and kind of a expense. Now you draw these two segmentals. Let's assume we are taking TNNM only still. I find out that in the related party, the profit is 15%, whereas in the third party, which is now giving me 10 crores of revenue, the profit is 22%. It could be other way around also. Related party is 15 and the third party is 14 or 12. Okay. Now, then these two comparisons also are permissible, and the judicial decisions have taken a view, internal comparables are better than external comparables. So if you have an internal comparables, always you should make an effort to adopt those internal comparables rather than jumping to external comparables. Okay. Now, if there is huge variation in profit, the questions we should ask, why is the variation? What is the reasons for variations? Is there any distinguishing factors between these two that these has caused this variation? For example, A gives me advance of 200 days, therefore I charge him 2% less. Is that situation? So there could be numerous business reasons why the margins are different. One has to analyze it. But this is a broad framework that you have to keep it in mind when you approach an transaction of this kind. So I hope you are clear on this. So this is where the services would come. This is where the services would come. That if I am doing rendering services to related party, how would I approach the transfer pricing aspects of those outbound services? We are talking of outbound services. Then look at other outbound transactions, sale of finished goods, sale of manufactured finished goods, traded finished goods, sale of raw materials. So some aspects what we discuss for services naturally applies to this also. Now, whether there are internal comparables. Now, you have manufactured a product, say a particular kind of pen or electronic gadget. You are selling to related parties and you also sell to third parties. In services, the selection comparison becomes naturally, in goods, this comparison becomes slightly easier because they are tangible. You know it what goods I am selling. So if I sell a laptop of so and so category to related party and laptop of so and so category to third parties, the direct comparison of price becomes easy. The variations are also known that it is a 4 GB, it is 8 GB, therefore this is the difference in price. Or this is with warranty, this is without warranty, therefore this is the difference in price. The quantification also becomes very easy. So if the Indian company is manufacturing and selling goods to its associated enterprise, then also how do you apply? You can take the same approach. First question you can ask is whether it is captive, because what could happen is for their global sourcing purposes, they might have set up a contract manufacturer in India. So they want, say, textile products, shirts, etc. for global sales, global supply. And they may set up a manufacturing unit in India, which will purchase the raw material locally and then sell to its related party. And that related party would in turn distribute to entire world. Okay. So that we generally call it as contract manufacturer, or we call it as a job worker or a contract manager, depending on what is the supply chain of the raw materials also in that. Now, there could be a situation where you purchase the raw material, finish it and sell it. Now, in that kind of a scenario, you may not have internal comparables. You may not have internal comparables. Naturally, you'll have to go to external comparables. The principle that we discussed for the services on the aspect of internal comparables, selecting how you select an internal comparables, how you select a PLI, those apply here also. Now I'm selling, so I'll have to again take cost as a denominator. I can't take the sales as a denominator. So those principles apply here also. So those principles are consistent across all, whether inbound, outbound, etc. Those principles are consistent. But when it comes to goods, the comparability that we take is what we have to keep it in mind. I don't have internal comparables, then naturally I will have to go to external comparables. I have to go back to databases and find out whether there is manufacturing of companies which are manufacturing similar goods. So if I take a manufacturer of mobile phones, then I have to find out a company which is manufacturing the mobile phones or similar gadgets. Here is what we call as product comparability and how you can go about in product comparability. And what is the manufacturing activity? Is it just assembling? Is it full-fledged manufacturing? What kind of a manufacturing is? So these are 2-3 aspects that you have to keep it in mind if you're doing an analysis for a manufacturing entity. Now, if I do a product comparability, can I compare different categories of product? Can I compare a fridge with a TV? If you compare the price, you can't compare, right? Because naturally, leave fridge and TV. In TV, only different sizes and features will have different price. So you can't compare. Can I go for, if I go for a net margin, can I go for a net margin comparison from a sale of fridges and sale of TV? The OECD guidelines gives an example of toaster and blender. Now, toaster and blender, you can't compare the price. Naturally, they are different product and have different functional activity. So you can't compare the price. But when you compare gross margin or net margin, in a net margin, what have you to look at? I'm not saying product comparability is not important in net margin, that is TNM, but you can go slightly broader. The reason is every business has a return based on function asset risk, what we call as functional analysis. So based on what functions you render, what assets you deploy, and what risks you undertake, your return is correlated. So if I'm a agent, commission agent, I'll get a commission on sales. But if I'm a Dell Cadre commission agent, I take a higher risk. So I'll get a higher commission because I'm also taking the bad debt risk. Similarly, in manufacturing, your manufacturing activity of toaster and manufacturing activity of blender, the supply chain may be similar, the distribution network may be similar, the efforts, advertisement efforts, the selling efforts may be similar. So when you look at functions, so when in a TNM, what you do is you slightly move away from direct product comparability, but you try and look at functional comparability, that are the product of similar nature, similar industry. And if they are so, you need not have the same product category. You should have a broad same product category. If I'm seeing FMCG, I may have a same FMCG, but I cannot compare food items with FMCG, for example, right? So you need to see where do you stop in product comparability? In TNM, when we are talking of manufactured items or even traded items. So you can go slightly beyond the exact product, but you can go slightly beyond. As I said, you can possibly compare of all, say, white goods. You can compare the margin of all white goods. You can possibly compare all margins from a food items. So you have to see where do you stop. Okay. And if you get that, discuss with the client, what are similar products in the same industry, which can be used as a starting point. In the databases, you can do a search with product name. You can say that you can give the companies into so-and-so product, finished products. Then you will get a companies which are into similar finished products. Then you start the next steps. Apply the filters, RPT filter, whether they are all rendering service, selling goods to their own associated enterprise. Try and see whether they are exporting or doing sales in the domestic market, whether the latest financial data is available. Because if you're comparing of the current year, you require current year data. You don't take the data of, say, 5 years old. So apply these parameters. And some of these parameters are now all inbuilt into a database. You just put the ratio and database throws the results. Either you can do it manually, exporting into Excel, and do it in the database. Depends on each person's convenience and trust on the data. right? So it depends on that thing. You have to select, if I have to do a search, now I have to select what are the different kinds of products I will compare, what are the different kind of filters I will apply to streamline to coming to a final set of comparables. Same process you will adopt, whether it is service, whether it is goods, whether it is something else. Database has various mechanisms to screen the companies. So you apply these parameters, come at a final set of comparables, pull out their annual reports either from the database, either from the stock exchange websites, either from the uh, companies' websites or from the databases. Try to look at the annual reports. They will give some description that we are selling so and so products, so and so goods. See their websites. You'll get the information. And from there, you see what is the margin on the manufacturing activity they are done. And now we are talking of manufacturing, so you cannot take a company which is engaged in trading of same goods. So I am doing manufacturing and selling, say, toasters. The other company may be buying toasters and selling it. You can't compare it because they are two different functional activity. The functional activity has to be same. Broad product comparability has to be same. If you apply TNM for outbound transactions or for other transactions also. So this is something you have to keep it in mind. This is how you are going to approach this particular kind of scenarios. If you want to go a step further and see, and you have access to global databases also, right? You are selling to your associated enterprise. Simple example we'll take. I sell at 1,000 rupees. He sells in the local market at 1,200 rupees. He makes 200 rupees gross profit margin. And his activity is buying from me and selling to third parties. Now, if you get this kind of a transaction, I have my manufacturing cost of say 700 rupees. I sell at 1,000 rupees and he sells at 1,200 rupees. Let's take simple example. In this simple example, I am a manufacturer. He's a trader, right? He's a trader. If you test yourself, you have to apply either TNM here and see whether 300 rupees what you have earned is correct or not. The other way to test is to see whether the 200 earned by him, whether is reasonable or not. What my point? If you say that 200 which he has earned in the geography in which he is operating, every person who is into this distribution activity is making 20% on cost or 20% in sales, whatever that formula may be. Then also you can complete, because if his purchase price is arm's length, you can say my sale price is also reasonable, right? If everybody in that geography made only 5% profit, whereas your distributor made 20% profit, that is your related party made 20% profit, then there is also a question, why did he make extra profit? That means, did your selling price purposely lowered to show more profit in the hands of subsidiary, therefore pay lesser tax maybe in that jurisdiction, right? So this is alternate approach. You may adopt it, you may not adopt it. Just keep it in mind, right? So either I can say that my sale price is arm's length, depending on comparables which I found in my own databases, in Indian databases, or see whether the AE, whether he made a reasonable profit. Many times you'll find that entities, say in tax havens, might have shown very high profit. They may be doing distribution activity with low manpower, but showing high profit. Straight away problem from a TP perspective, because how did they generate so much of gross profit when they did not have a substantial business activity? All that now gets captured in CBCR and other places, but that's for a different day. So this is another thought process that you can take while doing the analysis. Either you can see Indian databases, you can see foreign databases. There's some case studies we have put also on foreign databases and how the search happens on that. Again, just for more for knowledge, depends on each person's requirement and the client's requirement, one can adopt it. So these are some examples from an outbound perspective. Let's look at inbound perspective. What happens in inbound? When you receive, either import raw materials, import finished goods, or receive certain services. If you get this kind of a transaction, how you should approach this kind of a transaction. First, we'll look at services. Suppose you have received services. You'll find many of these transactions. Indian party makes payment. Indian subsidiary make payments to its foreign AE for services. The services may be, they say management services, accounting services, they may say IT services. How do you approach this, right? How do you look at these services? If you look at the Indian revenue authorities, the first question they ask when services are there and when you have made a payment for that services, is the service really rendered? Have the associated party really rendered the services? If they have rendered the services, what is the nature of services and what is the benefit the Indian party got from services? Right? No one would take services without they forcing some benefit for that services. You will find clients paying for internal audit to foreign parents, and when a CA goes and asks whether what is the fees for internal audit, they will not be ready to pay. Right? So in that scenario, why did they pay so much of fees for a particular service? And what is the charge for that service? So here, there could be various ways of approaching this. Once you get that, okay, this is the service rendered, this is the nature of service, this is the benefit I have got, and this is how they have performed the services. Suppose there is some sort of a procurement services product. I require raw material. They source the raw material at a global basis and give me the raw material. I use in Indian manufacturing and sell it to third parties in India. So there is a procurement services which has been provided. The question is, how did you derive the charge of these services? What is the cost that your associated enterprise incurred for these services? So they may have a center, 5 people sitting there, and those 5 people rendering the services to India. Right? So what is the salary cost of those 5 people and what is the margin the associated enterprise made in rendering these services? These are the critical questions that we should ask, that you give us this data. That if you have the AE has rendered services, what is the nature of services? What benefit you got? What is the cost incurred by associated enterprise? And what is the charge for those services? And on that basis, one can determine the arm's length character of those services. This could be one approach. Second, many times they will have common team which provides services to say 10 subsidiaries across the world. If that be the scenario, the questions that we will ask and the data one tries to get for that is that if there is a common services, what is the total cost incurred for that common team which is rendering these services? And what is the cost allocation mechanism between the 10 subsidiaries, between the 10 entities? So many times you will find that they are rendering services, cost is allocated based on number of factories, number of products, or revenue as a basis. So if that be the basis, fine, give us that details, that how the service charge has been derived at, what is the charge for that services. So this could be one of the ways of benchmarking the services, inbound services. Other major transactions that you will see in inbound is purchase of raw material, payment of royalty. They give us the technology. You use the technology for manufacturing in India and you sell the products to third parties in India. So let's assume that you are importing raw materials. Now, when you import the raw material, the issue will be generally these raw materials will be unique. You may not get the same raw material from third parties. That's the general scenario that at least I have in my experience team. So there is no substitute product for that raw material because you have they have that unique characteristics. Plus there will be a mandate that because you are selling in a brand name of a foreign company, only so and so raw materials can be used. They would also provide you technology for manufacturing that particular item. Suppose there's a Toyota which is there which manufacture cars. So the technology to manufacture cars, the main critical components like engine, etc., may come from related parties, right? Now, again, here the price level comparison practically is not possible unless they are commodities. So, if you buy a white sugar from your related party, then you will get a white sugar price on the stock, on the exchanges, commodity exchanges. Then it is a very easy comparison. Suppose you buy a raw sugar, process it and sell as a white sugar, then you can get a price of raw sugar very easily available on various like New York Commodity Exchange. You will get that price. Or if it is a metal, you go to LME, London Metal Exchange, you will get the price of a particular metal. So if there are commodities, you purchase those as a commodities, then the comparison on particular date can be done with the running prices on an exchange. That is permitted now. Earlier, this was not there, but with the insertion of sixth method, any other method, Rule 10 AB, you can take that as a basis of comparison. And if the basis for charge is based on those prices running in those so and so commodity exchanges, that can be a basis for benchmarking And under the cup method, that can be taken as comparison, or the other method that can be taken as comparison. Now, if that is not falling in that category, if it is not falling in that category, but they are unique, internally manufactured by associated enterprise, then what do you do about it? So you have purchase from related party, royalty paid for related party, certain other local components procured in your P&L, and other processing manufacturing cost. Sales are to third parties. So this is the broad P&L that you will find in most of the manufacturing entity, right? Now, in these cases, given the limitations of data, only one can adopt is TNNM. Again, transactional net margin is what you can adopt, and then compare the net margin of your associate with the net margin earned by comparables, again from external databases, who are engaged in manufacturing and sale of similar products. So that would be the basis of comparison which you will have to take. Okay. Now, there are various questions that will arise in this process. Because you also paid royalty. What about royalty? You may also get certain services. What about services? Unfortunately, at least in India, we do not have the segregated data of this. For example, royalty. If you go to global databases like royalty stat, etc., you will get the rate of royalty in for different industries, for different technologies, which is available. In the Indian databases and way it is today, you don't get this data available. At least earlier, 15 years back, DIPP used to publish certain agreement details and all. Those data currently are not available. So that becomes limitation to say that what is the appropriate royalty rate, whether 5% is appropriate, 6% is appropriate, 10% is appropriate. We have all been using a shortcut way to say that once I adopted TNNM, I'm comparing the net margin, and the net margin arrived is after debit of royalty. So I purchase cost, royalty cost, and other services cost. So if my net margin is arm's length, it presupposes that the other transactions above the net margin, that is purchase, royalty, are also at arm's length. This is indirect way, which is sort of a shortcut that we have all been adopted. Fortunately, tribunal has accepted this particular methodology and said that, okay, if the net margin is arm's length, you need not separately benchmark each of the transactions above, and all transactions are taken to be arm's length. This issue is pending before the Supreme Court. Based on what Supreme Court decides, as and when it decides, there could be some issue with related to this kind of benchmarking. Currently, that is possibly the only option available with most of us, unless you go to global databases where you can find transactional details of royalty and other transactions. So this could be one way to look at the cases where you have purchase of raw material. If you have purchase of finished goods, and those finished goods are sold in local market, you will find a lot of MNCs doing that. L'Oreal, for example, it will buy the cosmetics and sell it to it will retain its gross margin. It will incur distribution expenses. It will incur advertisement marketing expenses, and then sell these products to third parties in India. Now here there is a simple purchase and sale. The purchase is from related party, no value addition done, and sale to third parties. In this scenario, the resale price method is the most appropriate method to be used, because resale, that means purchase and resale. The method name itself suggests in what scenario you can use this particular method. So a resale price method can be used in this scenario, in this kind of inbound transactions, and can be seen. Here you will have to find out the gross margin. So you are only looking at the gross margin. You are looking at 5 components here: purchase, sales, opening stock, closing stocks, and expenses related to purchase. Based on those items, you decide that the gross margin earned is arm's length or not. If your gross margin earned is arm's length, then those transactions also can be considered as arm's length. So this approach one can adopt. Again, if you're going for external comparables, database search, all that has to be done. Some case studies are there which will take you to how to do the search, etc. But this is the broad outline of what one can do if he has to deal with this particular transactions. As I said, a couple of more important points we will discuss. Then we'll also see some compliances because I've left with another 10-15 minutes. The rule 10B is what we have to keep it in mind, rule 10B and 10CA. In 10B, the data to be used, what data you can use? You have to use a current year data. You have to use a current year data for comparison purposes. That was slightly modified in 2014, where you could go for 2-year preceding data. Suppose if you say that for TP study for financial year 21-22, what is the data you will use? That means the comparable data also should be of 21-22. You can't go further down. That's the first point. Second, if the current year data is not available, then you can go 1 year backward. So if I'm doing 21-22, I can go up to 2021. So because what would happen is in the external databases, even the comparable data takes time to get updated. They have to file their annual reports. They have to file with MC or stock exchanges. That annual reports need to be pulled out by the databases, and then you need to put that data, get it integrated into their databases. That process may generally take some time. So many times you'll find that when we do the TP study for in the month of October, because October 31st being the timeline for compliances, then what you would do is go for 1 year backward data. You can take the data of 2021, which we call as PY1. That is, and do the comparison. So your current year data with PY1 data of the comparables, if it satisfies all the tests that we discussed earlier, functional comparability test, it should not have related party transactions. If we are export, it also should be in export, and data availability. Same functional comparability. If these tests are satisfied, then you take that data of the last year, see the margin earned in that last year, either gross margin or net margin, and that you can compare with the net margin earned by the assessee. That could be another way of doing it. What it further provides is you have to take weighted average margin, and weighted average margin is based on rule 10CA, where the weighted average margin of 3 years has to be taken. So current year, PY1, previous year 1, and previous year 2. If you take previous year 1, then 2-year weighted average margin has to be taken. So if you take the data of a comparable for 21-22, then you also have to compute the margin of earlier 2 years, PY1, 2021 and 19-20. Take 3-year sales, 3-year operating profit, 3-year cost. And based on this, you get the weighted average operating margin. And that is the margin which you should adopt for comparison. If you take previous year 1, that is 2021 in our example, then you have to take 2-year weighted average, 19-20 and 20-21. Add 2 years sales, add 2 years cost, you get the 2 years profit, and that on the 2 years sales becomes the ratio that you should adopt. This is the formula given by rule 10CA. Correctness of that is not something which we have to debate, but this is what has been given in 10CA and that we have to adopt. In RPM, CPM, TNNM, you have to take average for 3 years. You can't take only 21-22. Yes, you have to take average for 3 years. And now you find that the comparables are 6 or more, you have to go for quartile. And if there are less than that, you have to go for arithmetic mean. This is a simple thing, you have to keep it in mind. Now, if you have 6 or more, the range is 35th percentile to 65th percentile. Suppose you have 10 comparable, you arrange them in ascending order, and the 4th comparable will be 35th percentile. So that is the lower end, and 7th comparable will be the upper end. So this is the range which we call as arm's length range. If you take mean, suppose you have only 4 companies, then the average margin, arithmetic mean of those 4 companies plus an 3% average, 3% arm's length range becomes the arm's length range. So you have the concept of 3%. They have given a bandwidth because TP is not exact science. You really don't get exact comparables. So they have given a leeway of 3%. That means if I sell to related party at 100 and I sell to third party at 102, now the difference is only 2%. And if you are adopting arithmetic mean, then 2% is tolerable. If your comparable is 104 and yours is 100, you are doing a sale. That means you have sold 4 rupees less. then it is not tolerable because it is beyond 3%, right? So then the adjustment is 4, not just difference of range. Adjustment is always from mean to the transaction value or median to transaction value. This is something which again you have to keep it in mind. And for wholesale traders, this range becomes 1%. The tolerance band becomes 1%. For other cases, this becomes 3%. And 3% or 1% should be used only when there are 5 or less comparables. Once there are 6 or more, you have 35th percentile or 70%. That is a band, interquartile range. So this is again something which you have to keep it in mind while doing the calculation. More the comparables will be better because you get a better result. But again, depending on industry, you may get more comparables, you may not get more comparables. So this is how one has to compute the range. Selection of comparables we have dealt with. These are the documents which should be maintained. I'll skip this portion for paucity of time. Okay. So this is what the general TP documentation we have. Apart from that, one may have to comply with master file and CBCR also. In certain cases, this may be applicable. Master file part A is applicable in all cases, 3CAA. The due date is same as due date for filing tax return. Every case where TP is applicable, where you have an MNE group, what we call as MNE group, in those cases, 3CAA part A is mandatory. In every case, you have to file it. This is mandatory. In every case, you have to file it. The challenge comes in part B. Now, why this came in? Master file and CBCR. There are two requirements which came in because of the BEPS project. Now, BEPS project said that, as I said, is a base erosion profit shifting. The master file gives a master overview of the entire group. And CBCR is country by country reporting. CBCR. Now, these are applicable to large groups only, not applicable to everyone, but just for you to keep it in mind that if the subsidiary in India is something which is a part of larger group, it may still be applicable. In CBCR, you do a reporting country by country. Reporting like what are the sales, profit, employees, assets, intangibles in each country. So how much is in India, how much is in Dubai? The comparison here in a basic, to give a simple example, suppose you are showing 10 crores of 1000 crore of profit in Dubai and there are only 2 employees there. By seeing a CBCR, the tax authorities will be able to question that why there is so much of profit in that tax haven. Because you have to get a single country-wise P&L. So not P&L as such, but you will get a basic data. There are 7 to 8 items of data which will be available. This is filed on a global basis. So Indian companies will file in India and there is an automatic exchange. Indian government will give to government of other countries. Similarly, US companies will file in US, Indian government will give it to the Indian authorities. So Indian TPO will have this data. The Indian subsidiary may not have this data, but that officer may have this data. So this is something which is there. So there are 2 requirements in this. One is master file, one is CBCR. As I said, part A is mandatory in all cases. Part B will be applicable if the turnover criteria is satisfied, which is 500 crore group consolidated turnover or 50 crore international transaction value or 10 crore if it is intangible. If this is there, then the master file of a group has to be filed in India also, which is part B of form 3CAA. This is a file which the group would have created at group level. You can take a copy of that, fill up this form and file it. If they're not created at a group level, then you have to file it. This is a mandatory requirement, right? 3CAB is if there are many companies in India, only one company in India can file a master file. Suppose there's a Toyota group, there are 10 companies in India, not all 10 need to file, only one needs to be filed. And the person who is filing will take responsibility for all the 10. That is the form of 3CAB. More critical form is 3CAC. This is the CBCR. Now this is applicable where the consolidated group turnover is 6,400 crores. India turnover is not relevant. Consolidated group turnover of the group, entire group, is greater than 6,400 crores of a financial year. It may be calendar year or it may be financial year. That doesn't matter. Whatever the financial year is followed by the group, that financial year, if the consolidated turnover is more than 6,400 crores, then this is a global limit. Everywhere in the world, they will file this. Now, the question that you have to ask the client is, whether your group has filed CBCR, say in your headquarters, say in UK, have you filed this CBCR? If you have filed a CBCR there, then in India you need to just file the intimation 3C CEAC. This is an intimation saying that my group is liable for CBCR and my group has filed a CBCR in UK. And this has to be filed within 12 months from the end of the financial year of the group. So if the group is having December as a year ending, then you see the next December for filing the intimation in India. If the group turnover is more than 6,400 crores and they have not filed CBCR anywhere, then you have to file it in India. And that is where the challenge will arise. Right? So if you have an Indian constituent entity, which is part of a group turnover of 6,400 crores, and it has not, that company in headquarters is not filing the CBCR, then in India you will have to file the CBCR, which is form 3CE AD. Or every Indian multinational who is above 6,400 crores has to file the CBCR. They have to file it in India and India will exchange it with everyone. So two circumstances where CBCR may be relevant is turnover limit of 6,400 crores. Indian MNC has to file it in India because it is headquartered in India. So Tata Group, it has to file in India. Reliance Industry, it has to file in India. If you are part of a group which is not either filing in those countries or it is filing in those countries but India does not have exchange of information with that country, then you have to file it in India. Otherwise, a simple intimation 3CEAC is sufficient. So this is again for you to keep it in mind. In a particular case, this may be applicable. Just have a look at it. If it is applicable, then try to comply with it. Another aspect is safe harbor rules. We were discussing of inbound, outbound services. There could be circumstances where safe harbor are applicable. And what are safe harbor? Safe harbor are a margin given by the government. The government is saying if you're rendering software development services, have 17% on cost, we will not ask any questions. So in cases where safe harbor are applicable, then you can suggest the client to maintain that much of margin. So then there is no TP issue for that client at all. And there's a particular form that needs to be filed. The services which are covered are software development, information technology, KPO. For loans, they have provided rate. For software R&D, pharma R&D, auto components, core auto components, non-core auto components. For these services, they have given rates. The margins have been given, rates have been given. If in a given scenario, the assessee can opt for safe harbor, do the relevant compliances and opt for safe harbor. Then you don't have any other complications in that particular case. This is a safe harbor, secondary adjustment and thin capitalization, other two, but maybe because of paucity of time, we'll try and cover it in any other things. But I can take questions. Maybe I have another 5-10 minutes, can take questions? Yes. Yeah. So his question is, related party margin is 18%, internal comparables, which are comparable, 40% margin, and third party external comparables is 20%. What would you do in a particular scenario? Okay. If internal comparables are reasonably comparable, as I said, I've given some parameters, right? If this test is satisfied, whether in terms of functionality, risks, or other aspects, if this test is satisfied, in the comparability test is satisfied, then it is going to be very difficult for you to ignore the internal comparables. The international guidance, OECD guidance, UN guidance, Indian judicial precedents, all prefer internal comparable to external comparables. The reason is internal is more closer because the services can be easily mapped, right? Now, if you want to reject internal comparable, then they have to give you distinguishing factors between related party transaction and third party transactions. What could be the distinguishing factors? Character of services, nature of services, terms of agreement, payment terms, or something more. You need to see what kind of difference it is. Say the related party is only 1 crore and that is 100 crores. So I would have given a quantity discount in a normal scenario. So you need to find distinguishing factors. Just ignoring this is depending on luck. If the luck is good, doesn't get picked up for scrutiny, fine. But if the client case gets picked up for scrutiny and the officer asks you this question, why have you not taken internal comparables? Then there is a surely going to be difficult scenario which cannot be sustained at the tribunal level also. So there, it is not that you can't go for external comparables, but you will have to identify distinguishing factors why internal comparables are not really comparable. That is a distinguishing factor. That could be, yes. As I discussed in the beginning itself, geographic market dynamics is one of the comparability factors itself listed in Rule 10B. So if that could be one reason to say that I am rejecting an internal comparable. That is what you have to see. See, when there are internal comparables, the question of going to external comparable itself may not arise. So there is no logic in going to an external comparable when internal comparables is available. If you see the rules also, they say you take uncontrolled transactions entered by the enterprise or by others. So when you have by enterprise itself, which is a very good comparable, the question of going to external comparables itself will not arise. You do not have any judicial precedent or legal basis to back up that I will mix internal and external comparables. See, there could be two things which will happen. One, you get this markup every year, right? This markup may be required for future expansion. This extra money you may require for future expansion because it goes back into your working capital cycle. Or you have to declare it as dividend back to your parent company. And if you really do not have any requirement of that cash, you'll have to declare it as dividend only. All other methodologies where people were adopting like buyback or something else or all that have been gradually curbed. So now the buyback tax is also there. Either go for a buyback tax or you can possibly go for a dividend payment and they would get credit for dividend tax paid in India. And you need to see which is more efficient, tax efficient, both from cash flow perspective and tax perspective and decide it. But otherwise there is no other mechanism. Most of the cases they may require funds for expansion if they are gradually increasing their headcount or things like that. But in a scenario where it is not required, most of the companies will have to declare dividend. You will require the funds. Suppose you want to take a new premises, then you that cash flow naturally will get, the reserves will be there, but that gets reflected in your assets. So depreciation anyway will come. So the markup will be on that. Yes. So if there is as I said, you need to again see whether product comparability, if you are comparing the product comparability, one, market dynamics will anyway come into picture. As you are saying, he is buying say t-shirt from me and also buying t-shirt from another person in India, same quality, all parameters are there, then that itself is a comparison that can be compared. That is also a different kind of internal comparable. Okay. See, now issue of shares. If you look at the transfer pricing regulations, the section 92 says income arising from an international transaction shall be computed having regard to arm's length price. Now, whether in case of an issue of share, is there any income arising? It's a capital transaction, right? You have to go back to two cases of Shell and Vodafone, where they issued shares and it was one of the very large cases and I mean, those were days where you would hear that TP adjustment of 5,000, 10,000 crores, 80,000 crores were made. 80,000 was the cumulative figure, and that was a very large number 10 years back. So what the officer did is, you have issued shares at par, say 10 rupees. The valuation of your balance sheet is 85. So ideally you should have issued at 85, right? So that 75 remained with the AE. This is the argument of the officer. 75 which remained with the AE is like a loan you have given to AE. And on that 75, I will also charge interest. So this was the kind of adjustment made. But look at this case. If I really had issued at 85, whether that 75 extra which is coming would have been taxable? It's a share premium, capital item, 92 or 224 or 45 itself would not be there. The associate argued in High Court, look, if I had actually received it was not taxable, and now I have not received, you are taxing it. The Bombay High Court in Vodafone's case said that this is not applicable. The transfer pricing does not change the charging provisions. The transfer pricing are only computation provisions. So if there is a taxability, compute it. If there is no taxability, there is a question of computing it. So if a transaction is exempt under 47, there is no transfer. There is a question of recomputing the price, right? So the Bombay High Court held it that these transactions are outside the TP provisions are not applicable to these transactions in the famous Vodafone's case. Subsequently, government realized this. They issued a clarification that issue of shares, TP provisions will not be applicable. The problem is with the form. The form today still has a line item, issue of shares. Technically 92 itself doesn't apply. Why should I fill up in the form? On a conservative basis, you can fill up in the form with a note that there is no arm's length price for this. Transfer of shares, yes, there is an arm's length price because there is a capital gains arising from transfer of shares. But from issue of shares, there cannot be an arm's length price. So ideally, the form should have only covered transfer of shares. So there could be a transfer of shares of an Indian company by a parent company to another group company or to a third party. There could be such scenarios which arise. But for issue of shares, ideally, it should not be there. The problem is with the form. In my personal opinion, it should not even come in the form. That's again, the way you want to disclose it, but TP cannot apply to issue of shares. So now this is again a case where there is a purchase. I purchased 100 crores of goods. I have not paid that money to my related party. So 100 crores payable is sitting on the liability side of my balance sheet. There could be a reverse scenario also. You have actually provided services and AE has not paid you. First we'll take his scenario, right? In his case, not paying has benefited me. He's benefited me. If I had paid, naturally cost should have gone outside India. If I'm not paid, it has benefited me. In this kind of a scenario, 92.3 will rescue. 92.3 says transfer pricing adjustment cannot be made to reduce income in India. It cannot be made to reduce income in India. So if in this case, there was a payable, any third party would have asked you interest. That okay, you are having 10 crores of payable, you are not paying from 6 months, either give back my money or give me interest of X percentage. Right? So here, at least in a payable scenario, 92.3 would say that TP provisions cannot be made applicable where you want to reduce income. So you can't apply to say that, okay, my total income was 10 crores, now I make it 9 crores by making a TP adjustment. You do it before hand only in your books, but not applying outside books through a TP mechanism. Where it is a reverse scenario, I have rendered services of 100 crores or sold products of 100 crores and I am not getting back this money. Then that receivable sitting on the balance sheet side, which you are not recovering, say for 2 years or 3 years, then there will be a problem. And now the tribunals are taking a view that this receivable, which is staying in your asset side beyond a reasonable period, beyond a reasonable credit period, depending on each case, the reasonable credit period would be different. on that you should charge notional interest. Suppose the credit period is 90 days, just I'm giving a hypothetical example, and receivable is for 1 year. The days in excess of that 90 days in interest calculated at LIBOR rate or so and so, that becomes your income, TP adjustment in India. And this is something which you should have to be aware of. Again, there is no problem because it is beneficial. If that situation is there, in generally the goods, if you're providing within a period prescribed in FEMA, there should not be a problem. But if you are keeping it for 2 years as an advance, then questions may arise. If it's a running account, that should still be okay. Appeal. Okay. Okay. That would be incorrect by virtue of 92 CE, secondary adjustment. Either, now if it is a adjustment post 1718, assessment is 1718 onwards, if the TP adjustment either falling in any of these 5 categories, suo motu adjustment, adjustment by assessing officer, adjustment based on APS, safe harbor or MAP, you need to get that money into India, or you have to assume that that money is paid to them as dividend and pay tax at the rate of 15% on that by virtue of 92C. This reporting also needs to be done in clause 30A of tax audit form 3CD, that this is the amount of secondary adjustment, this is the so and so interest on that. So, I mean, depending on a case, you need to see applicability of 92CE read with rule 10CB. There is a calculation, there is a time period given within which it should be brought into India, and there's an interest calculation there. And if you don't want to do that, you can pay 15% on that as a tax. But otherwise, there will be a problem as and when it arises. So receive money towards what? So it was an opening balance against which the money has come. No, not it. Not. No, that again, as I said, you see the facts. You see the facts, whether this receivable was for a long period, why it was receivable. And I mean, you'll have, that depends on each case. You'll have to see that. Yes. So these are complications. Secondary adjustment is an issue which they have not addressed properly. These are FEMA issues there, accounting issues there, MAT issues there. So I get it in 3rd year or 4th year, whether I have to pay MAT on that. Whether there can be a scenario where again it is taxable in that year. So ideally, they could have made a clarity of this. In the first year when it was brought in, a lot of issues were raised. So they gave that alternate mechanism that you don't get the money, pay 15% and finish it. So in an ideal scenario, assessors would opt for that because that would mean that. Otherwise, the interest is in perpetuity till you get the money, and if you don't get the money, then it is in perpetuity. Second, look at a person who is in that country, whether he will be permitted to be given. So that's why 15% would be there. I think running out of time. Thank you everyone for patient hearing. And again, as I said, thank you branch Chairman Pramod for giving me this opportunity to share my views. Nice questions for me also learning. Thank you everyone. Thank you.
Thank you, Narendra Jain. Definitely, it was a value addition. Of course, your professional insights did help our members. Thank you once again for gracing today's conference. I would, as a token of gratitude and respect, I request Bhatt sir to come up on the dais and hand over a token of appreciation to you as a mark of gratitude and respect. Thank you, Narayan sir. We'll quickly have a 10 to 15 minutes coffee break and reassemble quickly.